Elon Musk just announced that xAI plans to scale from 230,000 GPUs to 50 million H100 equivalent AI compute units over the next 5 years. That's a huge leap, enabled by rapid deployment of Colossus 2, which is already running 550,000 NVIDIA GPUs. Musk claims it was built 73 times faster than industry norms, completed in 19 days compared to 4 years. To support this level of compute, xAI will need about 35 gigawatts of power. That's around 2% of global electricity use. To meet that demand, Musk is exploring power-efficient designs and even acquiring full-scale power plants. He's already relocating an overseas facility to the US, signaling how serious this build-out is. This could reshape capital markets, energy infrastructure, and the AI industry. If each H100 equivalent unit costs $25,000, xAI's 50 million unit target implies a $1.25 trillion AI hardware spend over 5 years. Even if xAI doesn't fund it all, this sets the total market demand. For NVIDIA, if it supplies just 30% of these chips, that's 15 million units. Multiply that by $25,000 and you get $375 billion in NVIDIA revenue over 5 years. That's $75 billion per year, up from today's data center run rate of around $50 billion. If investors believe this scale is achievable, NVIDIA's valuation could expand sharply, pushing future expectations closer to $125 or even $150 billion in annual revenue. For Tesla, if xAI depends on Tesla energy for power infrastructure, megapacks could play a major role. At $2 million per megapack and 4 megawatts each, just 10 gigawatts of support capacity could mean $5 billion a year in new Tesla energy revenue. This could add $150 to $200 billion in value to Tesla's total market cap based on energy earnings multiples. For chip manufacturers like TSMC, the scale of demand helps lock in multi-year visibility. Foundries will likely see larger capex budgets and longer order books. If xAI succeeds, its own private valuation could soar. Microsoft paid around $10 billion for 10% of OpenAI when it had just 10,000 GPUs. That implies $1 million valuation per GPU. If that math holds, xAI's 50 million compute units could support a $500 billion valuation if it delivers commercially viable AI models or AGI. Now, on the energy side, 35 gigawatts is transformational. That's enough to shift energy markets. U.S. utilities like NextEra, Southern Company, and Vistra could benefit from direct partnerships, new contracts, or even acquisitions. Power supply constraints may drive prices up in local markets and bring more investor focus to grid-scale batteries, nuclear, and microgrids. For Tesla Energy, if xAI becomes a strategic customer, megapack deployment could double or triple. That adds a new growth engine for Tesla that's not tied to vehicle margins. Talking about competitors. OpenAI and Microsoft will need to respond. Expect Microsoft to boost capex even further. It's already spending $50 billion a year. If xAI builds faster or trains better models, OpenAI may need to pivot to more custom hardware or faster deployments to keep up. Google has its own TPUs, but will likely push harder for better energy efficiency. If Musk delivers 5 times better power performance than H100s, that's a serious challenge. Google might reallocate capital from moonshots to AI infrastructure. Amazon is falling behind. Their Trainium chips are not competitive yet. If Musk sets a new standard, AWS might need to make acquisitions or strike new chip deals to stay relevant. Otherwise, it risks just becoming a hosting layer. Meta is already spending heavily, around $30 billion per year, but their AI focus is mostly on ad optimization and LLM content delivery. Musk's focus on AGI, combined with full-stack control of compute and energy, forces Meta to either scale up fast or partner. Ironically, Meta might even end up licensing xAI models in the future. Broader economic effects include a $1 trillion AI hardware cycle over 5 years, similar to the smartphone boom. That means chip makers like ASML and Lam Research will see stronger demand and longer lead times. And if all this investment needs to be financed, bond supply could rise, nudging up corporate borrowing costs. There's also regulatory risk. If data centers eat up too much power, governments, especially in Europe, might impose taxes or restrictions on AI infrastructure. Now, from a market psychology view, this won't move stocks all at once. It's a long-term vision, but the leading indicators will be clear. GPU shortages, power purchase agreements, and energy infrastructure deals will become important signals. If Colossus 2 proves that xAI can train more efficient models than GPT-5, markets will start repricing NVIDIA, Tesla, and energy infrastructure stocks. Analysts will begin modeling AI energy GDP as a real economic segment. That means AI compute demand itself starts contributing to GDP through data centers, energy production, and hardware exports. In short, Elon is trying to own the entire AI stack, from silicon to software, and from electrons to intelligence. If he delivers even half of what he's aiming for, it changes the definition of who leads AI. For investors, the focus should shift from just chips to full-stack compute ownership, where energy, infrastructure, and model training capability drive long-term value. This marks the beginning of a new cycle, where AI infrastructure multiples will take center stage.